private companies across China, and there's opportunity.
I think also the Tencents or any of such companies which are peer-to-peer, it's all about statistics. So when so far it is granular and similar, I think it works. When it becomes large and bespoke, I think the model will fail. And that is
the model will fail.
That is exactly, yes. And that is where we are talking about corporates, individual large corporates, which cannot get funding from platforms because size will be too difficult to absorb, and the analytics of automation won't work. It has to come back into the picture, the experience and the history, because a lot of these companies have a history. Like one can look at the metric and say, oh, okay, this company looks good, but when you see the history of 98 all the way till here, you may not want to touch it at 2 times EBITDA, while on the other hand, you are willing to touch a company at 6 times and still it works. So that part, the intelligence will take time to build. And that's where I see that granular, small lending, fine, works. But large lending, large loans, still the jury's out.
Again, not to sort of throw water on this kind of raging fire.
But a little bit.
Kind of, actually, to throw water on this raging fire. I mean, we've seen this movie before. I'm sorry. Like, securitization is a good thing, fine, when done in the right sort of aligned ways. But history has shown us, and the biggest offenders of this, by the way, are the Americans, or were the Americans, that when you start moving the lender away from the borrower and they're not sort of looking each other in the eyes, that's when you get into trouble. When a Shinto temple in Japan or a water authority in Australia is actually the one who is lending to a house in Merced, California, that to an illegal alien who doesn't actually have a residency or doesn't have an income, but wrote it down on a piece of paper and claimed they did, on a house, we talk about loan to values, on a house that's gone up 400% in the last 3 years, that's when you start to see problems. And maybe I'm just really old fashioned and I'm not, sort of all about the blockchain and all that fintech and all that wonderful stuff, but I don't see how peer-to-peer lending is, whether it's in Asia or anywhere else, is very different than subprime. I don't see that. And you're right, maybe on a very granular sort of pool of, but once you get into, forget about large corporates, even in medium-sized companies, the reason why Lawrence Golub has been able to build this sort of big empire, and by the way, I agree with him, justifies the fees that he charges, is because he has like 125 people looking after the revolvers. And he has people who are actually looking into the eyes of these borrowers. And I don't see the trust banks doing that. I don't see the peer-to-peer doing that. And sadly, I don't see, I'm a big pro-bank person, but I'm not a pro sort of Asian state-owned bank. And I'm not saying that you can't, with your billion or 10 billion or 20 billion that you grow to, can't find opportunities. But if you look at the sort of Asian continent as a whole, that transition, I think, is going to be a tough one, because I think in many ways we are sort of just recreating subprime here in Asia. So you're right, the numbers of debt have grown. I think you were saying that was a good thing. I actually see it as quite a worrying thing.
Well, let's get Chris to put on his S&P ratings hat on and tell us, what do you think?
Well, the credit quality of these structures, whether it's trusts, loans, or more recently these sort of off-balance sheet banks lending, the quality, the fact that they have to go into the shadow banking channels means that the credit quality tends to be quite weak. So I would agree, in terms of protection, these are very low quality stuff. I think so far peer-to-peer as a percentage doesn't seem very large. The ones that I've seen successful, for example, like Ants Financials, where it's a sort of a working capital loan for customers or for suppliers that the platform is working with. They have a lot of information to assess the business position and also the financing position of these borrowers. And it's for a very short period of time. So in terms of control, and the platform has the collateral. So I think that sort of give...
So peer-to-peer is small, but Trust Bank is actually quite a large...
Quite a large, and they have collateral as well.
Would you draw the line between that and what's happening there and subprime?
I think it's very different because there are no tranching. You have just one lender, and you own the assets. And in terms of supervise, control and estimating the cash flow, and also the recovery, I think the trust banks have people to do that. I don't think it's a case where the borrower and the lender don't see each other. I think in China you do see each other quite a bit, and in the sense of a state-owned enterprise, in fact, the party and the regulatory agency are also involved. So I think there's multi-levels of control.
So let me jump in here just because Paul is goading me, and so I'll take the.
I'm glad that you two are on either ends of the panel here, by the way.
Should have seen last year's panel. You can look it on
We
YouTube.
fundamentally agree that growth in debt creates opportunity. My point is that where we are in the cycle of addressing that in China and India is NPLs are being recognized and have been recognized. We had a very tough RBI governor who did a very painful job in India, but made big companies and big banks address their NPLs so that it's public information over 11% NPLs. So when you have that, now is the time. Where I would disagree with you, because we've had the growth of credit, it is 2 years into the cycle, and you can buy portfolios in India, and you can buy individual credits when you want to at the right price. So a distressed cycle is here. It's not coming, it's arrived. So let me finish. And the same holds true in China, right? That we have acknowledged NPLs and special mention loans, which are 5.8% of bank balance sheets. So you can go in China if you have a dedicated team and you have 100% foreign control. We have a $3 billion balance sheet in China that's been lending there for 5 years, right? ROEs of that business 2 times levered, just like a non-bank finance, no defaults, right? 20% ROEs. So you can do deals, you can make money, and I would fundamentally disagree with your Western perception of where it is. It's already in the addressing time, the time to be thinking about it and recognize Asia learned and has been through multiple cycles. It's not like Asia hasn't learned this. 2098, 18 years, there are real professionals and firms that have been doing it for almost 2 decades through multiple cycles and making money. It's a timing point.
I think on top of that, there is one more aspect, which is what is happening in India. Once the NPLs have been recognized, underlying growth is there. And China, yes, it is slowing down, and it will slow down over time, and then again come back up. What we are talking about is still mid to high single digit.
It's still slowing in India.
And India is still mid to high single digit. It's like 6-7% compared to what we talk about, 0 to 2. Now you have here a demand for credit, and it is self-fulfilling because there is a growth, there is a demand for credit, there is a credit, there is a demand for growth. And that part is on top of the bank lending, which again currently is being fulfilled equivalent of whether you call it trust loan, alternative lenders, non-bank finance companies. But I think that will normalize. If you look at kind of over the hump outlook, overall, I think the banking sector, because they are government owned, will remain the bedrock and have to be for the capex cycle. And the non-bank would play on the margin on alternatives where the banks don't, which is consumers, real estate, regulatory issues in various countries on various sectors, and policy changes as they come along the way. But growth for both the sectors is definitely visible. And that is something that I think is different from Europe or the US.
So does that, going back to one of the points that Rob made very early on in the conversation, when he said that there are numerous markets out of there that are mispriced right now. Real estate was one of those markets that he pointed to. Are you saying that is not the situation in India?
No, real estate market is mispriced. No, it is not. No, India is starved of real estate financing. The banks have a lot of restrictions on lending. And by definition, the real estate market has been kind of flattish for the last 5 years, when the inflation has been there of even 5-6%, which means it is down in the real terms. But is it picking up again with the growth? Yes, it is. Now, China may have a different aspect to it, which probably maybe
depends on what markets you're looking at. I think tier 1 and some tier 2 cities, clearly overheating is the correct description. And prices have gone up so much last 12 to 18 months. I just cannot see how the yield or even the cash flow of some of these assets can be supporting those valuations. But the question is, for some of these cities, the investment demand is so high, and there are very little investment opportunities for savers in China. Where can they use the money for? What can they use the savings for? I think naturally that goes into the real estate market. And it's the only market where investors have consistently made money over the last 10, 15 years in China. Not in equities, certainly not in the bond market, but in real estate.
Well, doesn't this go back to one of the points, Rob, that you were making earlier on? And that is the Asian market is here, it's ready to be invested in, but there's still a huge amount of money on the sidelines. Now, isn't one of the problems of investing within this market is the fragmentation that we've just been talking about? These markets are so incredibly different. There are different regulations. You go back to the basics of languages, there's different cultures. Investing in Asia is not as easy as going to the US and taking that big chunk of money or those assets and breaking them apart.
I think that's part of the opportunity and absolutely part of the complexity of execution. So, 70% of Asian credit is loans. So by definition, we only have locked up capital. We think there's absolute opportunity in illiquids, but we invest in liquid and illiquid markets, but the capital we invest in always is locked up because you take great advantage of everybody coming in and out of Asia, as well as buying into fundamentally being able to execute loans means finding the best opportunity. So you're absolutely right. It is still a relatively immature secondary and investable market, but that is also what's created so much opportunity as its absolute dollar amount and a couple of decades of really being able to prove how to do it.
So I have a question for you, because I'm actually going to do something novel and actually agree with you, that, that the opportunity, I would say in global credit, but let's talk about Asian credit, is in the bank loan sector. That's a little bit like Europe. That's where most of the opportunity is. It's senior secured, it's floating. The problem, and again, we have had an allocation as big as I said earlier, 85% to Asia. The problem we have, though, which is maybe asking and answering a question that you were asking, is that credit in Asia is much harder when the defaults do happen because of the perceived or real lack of sort of rule of law when you go into, not an established bankruptcy code. Whether it's in India or China, by the time you actually have to start calling the lawyers, you're in big trouble. So the way that we have gotten over that when we have done our senior secured lending in Asia is only with banking partners, through banks where they don't have to rely on the judge or the jury to get the money back. They have sort of much more boots on the ground than we're ever going to have. So I think you agree with us, since you espoused it, that loans is the way to go, but you largely do it as a non-bank lender. So how do you deal with these defaults when things go wrong, when you don't have a bankruptcy code and a well-developed sort of bankruptcy system to defend you?
We actually do agree on this one. I would just say our addressing it is we become the bank. So you say you do it with a banking partner. So our platform in India is a controlled platform with 100% us and our two co-investment partners in there, and we are the bank. We have Sarfazi law, and we write our own documents, which means, and we can debate this, but I think my colleague would agree, you actually, when you write your own documents, you can enforce. And so it's really contract law that is difficult in India. So our answer is we've gone one step closer into the market. We've created our own team. So again, in China, we're in Chongqing, none of these overpriced cities, but in real China, 22 people who are sitting there, and we do origination, loan documentation, sourcing, and asset management. We are the bank, 100% foreign controlled. So I have all the trust. I'm not even trusting a partner. I'm trusting our own team.
But do they fear not repaying you like they may fear an HSBC or Standard Chartered?
Actually, they may fear you more, unfortunately. That's the truth. Especially in China or India. I think that's why the NPL ratio is 12% and banks cannot do anything.
Why?
Right?
Why would they fear?
They have all the laws, but then you have not one bank with 70% market share. You have 27 banks who cannot agree to anything. So yeah, borrower is divide and rule. So borrower, actually, when you have the same voice, you can get your answers.